We finally got a good closeout to the week, and to top all that off, I want to talk more about QDTE. This one is really taking the internet by storm and the investing community as a whole, with dividend investors just being pumped about this, and I'm definitely one of them. And what I'm more pumped about is Roundhill is announcing they're apparently putting out 10 new weekly dividend funds. It's going to be a while, but they have started the filings to create these new ETFs, and there's a ton of them. I think they're trying to go after the yield max market, and to be honest, I think they could do it. I'm so interested. Let me know in the comments if you prefer yield max or the Roundhill funds for the weekly dividends. But either way, we're going to be doing a video today on how you can replace your income with QDTE. Basically, how much money you have to invest and how many shares you have to hold to replace we're going to do the average salary in the US, which is roughly $60,000. So if you're interested in that and you're interested in learning more financial content about more weekly dividend stocks and about dividend stocks overall, go ahead and like and subscribe to the channel. That helps me out a bunch and you'll never miss a video, hopefully. So I appreciate you guys for being here. Let's go ahead and jump right into the data. So I pulled the data from Forbes Advisor, and this is where it says the average annual salary nationwide is just under $60,000. We're going to round up to $60,000. Some states are lower, some are higher, but that is what we have as the average. So we're going to use that for our calculation. But first, let's look at the Roundhill funds really quickly. Because I've done a few videos on the Roundhill funds, I'm going to hit just the key points, and feel free to skip ahead if you're familiar with these funds. The assets under management, 55 million, a little bit low, but the expense ratio of 0.95 is also high. So there are some downsides to this fund, but what I think is really cool, and they explain it really well, is the 0 DTE, is 0 days till expiration for the fund QDTE. And basically, because this one, it's writing a covered call strategy on the Innovation 100 Index, they are able to do these 0 days till expiration calls, collect a premium every single day, which is why you get it every single week. And then the bonus of that is they still own the stocks overnight. So for overnight, if you're long on something like this would be the top 100 funds in the NASDAQ, you are able to still make money in the after hours and pre-market trading, which is where a lot of movement does happen, but it basically opens you up to getting some extra income. And there are some tax incentives with these as well, which I think is really important. But since I've talked about it so much, if you're interested, check the videos linked at the end of the video and the one linked in the description below where I do a full breakdown on this. And let's go ahead and look at the dividend history. Looking at the dividend history, it has been all over the map, and we kind of expected that. When it comes to these covered call ETFs, this one is relatively similar to QYLD. They just do it differently, where they're writing 0 days till expiration calls rather than what QYLD does. But we anticipate volatility, right? You're not going to get consistent 30 cents every single month. You're going to get some with 57, you're going to get some with 30, you're going to get some with 20, and maybe even some with 9, and that one does hurt a little bit. But the reasoning behind that is the implied volatility, so what the stock market is doing. And so when the NASDAQ is bouncing all over the place, your premiums on the option calls are going to be higher. And basically that is because there's more volatility, and so you're risking more, and thus you make more money. Now, if they're good with these calls, you can turn that into some crazy profit. But again, there's always more risk, but more risk means more reward, at least in this case, not always. So that's a little bit of an options lesson. It is very complicated, and if you're new to options, that probably didn't make a lot of sense, but I hope it made some sense to some of you. Now, what we're going to do, we're going to calculate our own. So they have paid out 23 dividends. I counted off camera because it's really boring to count on camera. And so we'll run our own calculation. So we know that they've paid $7.33 so far. The dividend yield on here is not accurate because they haven't paid for a full year, which is what Seeking Alpha requires. And so we're going to take this 7.33 and we're going to divide it by 23. And this is going to give us our average. So our average is 31.9 cents, which is great. We're going to multiply this by 12. Actually, we're going to multiply it not by 12 because it's not monthly, it's weekly. We're going to multiply it by 52, and there's actually a little bit more than 52 weeks in a year, but still. So we're looking at a 1657. So we're going to go up, and then we're going to take this number, which is the dividend, and we're going to divide it by 42.40, which is the current price, and then we're going to multiply that by 100, and that gives us a rough dividend yield of nearly 40%. 40.1% for those of you that are very particular. And so I like to do this math to see what my actual calculation is based off of what they have been paying. And this is still an insane yield. So even though their yield is a little bit higher on the Roundhill website, I do think it is nice to double check things and at least to know how to double check things. So I actually don't even remember if their yield went up or not. Yeah, they're looking at a 67.4% dividend yield, and I'm not exactly sure why it's so high, but a 38, 39% yield, whatever we got, is still phenomenal. We're going to run the calculation based off their yield because it is the official companies, but that is important to know. So what we'll do now, let's look at the drip calculator and see how they have been performing. So I have thrown in QDTE, and we're just going to chart the 10K invested and just take a look. This isn't much information because the fund hasn't been out for that long. And it was negative early on, pretty negative, down what? A couple percentage points, probably 5, 6, 7% at that point. And now we're up. Total return 6.55% and an annualized gain of 13.75% is what they are kind of predicting for the full year. Now with dividends reinvested, you're up over a full percent more than if you weren't to reinvest those dividends. So I'm a huge fan of reinvesting dividends. I'm a huge fan of compound interest. It is one of the most spectacular things at our disposal as citizens. And so I love it. Now, I think that could really grow over time, and if this continues paying out these high yields, it could be phenomenal. I do own QDTE full. I am biased. I like this fund. I don't own a whole lot of it. I have a starter position because I'm going to track how it does in my portfolio. That is what I always like to do first. And some people, you may disagree with that, and that is completely okay. Invest how you want to. This is not financial advice, but I like to buy a little bit of something and just watch it for maybe 6 months, even a year. And if it performs well, I buy more. And that is how I like to check the waters. That's why I own so many different high-yielding dividend stocks. And I've sold some recently that didn't perform as they were predicted to, and I've purchased more of some that did. So that's just how I like to do things. Now let's jump into the calculation. And again, we're going to use their yield to calculate how much we need to get $60,000 a year. And we'll actually do it twice. We'll do one to get the 60 based off their yield and one to get 60 based off the annualized gain that is being predicted, because that might be a more realistic number. But again, you never really know, but we'll do both anyways. So there's a few more things I'm adding in. We're using the market beat calculator this time because it is a little bit more complicated. We have the initial dividend yield, which is 13.75%. And now I'm calculating this based off of the drip calculation yield that we've seen it perform so far. So that is a mix of the dividend and the price appreciation, or depreciation, depending. And so, big yawn. I have 100 shares entered. I have the share price. We have the individual stock. We have weekly dividends. We have no drip because we're just doing it for a year. We need to know how you're going to make $60,000. And so with 100 shares, which is a little over $4,000, you're making $624 a year in dividend income. Now, I think that is really important. They have the yield on cost being a little bit higher, but 100 is... that's pretty decent. This is still a very good yield. People are saying it's nowhere near 60, and I know that. I know that it's not, but it's a pretty phenomenal dividend yield. Let's be honest. So let's bump this up a little bit. Let's go to 500. We know we're not necessarily close to what we should be looking at. Okay, with 500, we have $21,200 invested, and our annual dividend income jumps to $3,120, which is phenomenal. I'm thinking with my account, if I were to just pull everything out and invest it into this fund, getting that much a year would be pretty good. And this is lower than the yield that they're anticipating, but we're still not there. We need what is it? A little $5,200. So we're not quite there yet. Let's jump it up to, let's say 800, and let's see what 800 shares gets us. So with $33,900 invested, we're just short. We're going to go to 900. 900 will do it, 100%. Yep, at 900, so $38,000, you end up getting $5,600 every single year, which when we divide that out and divide that by 52 roughly, you're going to get close to $100 because this one does pay weekly. So, I'm going to run the numbers quick. We'll divide that by 52, and it's $108. $108 is phenomenal to get every single week. So there it is. That's that calculation. Let's go ahead and jump into the calculation based off of what they say their yield is and see how it compares. A disclaimer, again, this is just based off the yield. I'm not factoring in price appreciation like I did with the last calculation, and I'm not sure how it's going to impact whether the price goes up or down. That is what will dictate that. But we have all the same information, and I just changed the yield and number of shares. We start with 100. At 100, you have $4,240 invested. Pretty easy math. And that already gets you $4,000 in yearly income, which is insane. Absolutely insane. Now, the yield on cost has jumped like crazy, and the total dividend payments over 1 year is very interesting. I'm not sure how different these numbers are, or why they are so different, I should say, but we're going to go based off the annual dividend income because we did that with the last one. Now, to kick this up, I mean, we don't want to go much higher. We want another 1,000, so I'm going to say like 130 shares. I'm good. I'm good at what I do, ladies and gentlemen. Mostly gentlemen, because I have like 5 female subscribers. Anyways, that's all right. I'm not angry. Welcome, ladies, if you guys are watching this. Anyway, so we have that $5,500 as our balance of what we have invested, and our dividend income comes out at $5,256 every single year, which again is what we're looking for. That's going to be just over $100 a week, which is phenomenal. And now I want to show you guys the power of these funds, where if it does perform this way, I didn't do this with the last calculation, but it's more fun to do it with the huge numbers, even if they're less realistic. So we start doing 10 years. This is absolutely hideous. This does not show me anything that I want to see. But over 10 years at the weekly distribution, and we have to add drip. We have to add drip. And we see the power of the dividend income. So portfolio balance is continuing to increase over 10 years. 10 years with what? $5,000 invested? Well, one, you'd be up 80,000%, 81,000. So not too realistic. Again, the yields are insane. We haven't seen what these funds can do. It is possible. Blah, don't come for me in the comments and say it's never going to happen. I'm not disagreeing with you. But the dividend income, so over 10 years, at year 9, you're making almost $800,000 in dividend income. But year 10, you're doubling that at $1.5 million in dividend income, which is just absolutely insane. Your yield on cost continues to go up. I understand. I don't know why I blanked on yield on cost, but that's the power of these funds, and that's why people are freaking out about them. And let me tell you, last thing for this video, the reason these are so strong is because you're compounding weekly over monthly. So you are compounding a lot more often, and that gives you more power, because instead of getting your payment every month and reinvesting that, you're getting it every week and reinvesting it. And so it makes a huge difference when it comes to drip in the long term. A huge difference. Like, let's actually see if this was a monthly payer. 4.4 million goes down to 3.8. Still an insane return, but that compounding weekly is what makes it such a big difference. So I hope you guys enjoyed this video. Don't forget to like and subscribe. Do me a huge favor. I appreciate you guys for watching. And that's it. Have a great weekend.